Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, definitely hit like and subscribe so that you can see future videos as well. So today we're going to be talking value investing. This video is a little less planned out than I would usually make them, but I've been reading a couple things that I want to bring up, and I've seen some articles and various videos and bits and pieces that I just want to speak on and give sort of my opinion to. So I don't know where exactly this video is going to go, but if you do enjoy it, hit like. Really does help out the channel and kind of pushes my videos out to a wider audience and all that kind of stuff, so that we can continue to grow the channel and kind of keep doing this. So let's get into it. So first off, I just want to talk through a couple of things in this book called Ben Graham on Value Investing by Janet Lowe. It's basically a biography of Benjamin Graham's life. If you don't know who Benjamin Graham is, he's basically the father of value investing. He really helped to popularize these concepts of margin of safety and assessing the intrinsic value of a company, and trying to get across the message that the intrinsic value of a company is completely unrelated to the market price for that stock. So it creates opportunities whereby you can buy a business for less than it's worth, and you can sell a business for more than it's worth. And Janet Lowe also wrote Damn Right, which I've also got over there, which is a Charlie Munger biography. So if you're into those sorts of books, they're definitely a good read. So a couple of the things that I picked up in that particular book that, as I say, sum up value investing quite well. There's two sort of quotes from Ben Graham and David Dodd, actually, I think was the second one. So the first one actually comes from an article that was written by Ben Graham in the 50s, and a bit of a weird situation, but he wrote this article for a woman's magazine. I think it was called Mademoiselle magazine or something like that, and he probably couldn't get away with wording it this way in 2019, where we're in the land of snowflakes and everyone seems to get offended by everything, but I hope I can use this example today and you guys don't crucify me too much for that. But basically the example Ben Graham used is a bit patronizing, but he basically said that women have this innate ability to find bargains whenever they're out grocery shopping, and they, whenever they go to the supermarket, they're looking to get the most they can for their money. And Ben Graham recommends that when you go out and invest, when you try to buy securities in the public market, you invest in stocks, invest in businesses, you want to treat that endeavor just like you would grocery shopping. You want to get the most you can for your money, and you don't want to treat it like perfume shopping, is the way that Ben Graham worded it. So in other words, you want to get as much value as you possibly can for the lowest price. And even though there are extremely high quality businesses out there, and businesses that are growing at a phenomenal rate and all these things, you can turn that into quite a poor investment by paying too much for it up front, regardless of the quality of that company. So that's the first thing I read. The second thing I read is something that I think is often missed with a lot of newer investors, and something that Wall Street doesn't tend to admit all that much. And basically, that part of the book was saying that intrinsic value, when you estimate that, is not an exact figure. And I know that I'm probably a little bit guilty of this myself. One of my most popular videos on the channel is how to calculate intrinsic value, and it comes up with quite a precise number. You can calculate that out to multiple decimal points if you really want. But what you'll notice is the variables that you put into that sort of calculation. So the growth rate of the company, the current earnings of the company, the discount rate, the length of time that you do this analysis over, all of that has quite a major influence on the end result that you get. So we used Apple in that example. I think we said Apple was going to grow at 12% a year or something like that. If Apple only grows at 8 or 10% a year, that intrinsic value changes dramatically. If Apple grows at 15% a year, it changes dramatically again. And if we say we want a 20% return instead of a 15% return, or we say we want a 10% return instead of a 15% return, again, that changes the intrinsic value of Apple dramatically from those calculations. So what Ben Graham and David Dodd recommend is to just understand that as much as you may like mathematics and as much as Ben Graham was really into mathematics, intrinsic value is not something you can really pin down to the third decimal point. It's going to be a range. It's probably, in the example he gave, give yourself a 20% sort of range for intrinsic value. And buy with a margin of safety. That's one of the main reasons we try to buy businesses for a lot less than they're worth. We're not trying to buy $1 for 98 cents because that falls within margin for error, not margin of safety. So we're within that 20% threshold, and there's, just as big a chance that we've actually bought that $1 for $1.10 as there is that we've bought that $1 for 98 cents. There's margin for error in these calculations, and because of that, we should be hunting for the big discounts, those 30, 50, 60% discounts to intrinsic value, and that way we're going to simultaneously decrease our risk. We're minimizing downside by buying something for much less than it's worth over the long term, and we're maximizing our upside. So just as sort of the further away we can get from paying $1 for $1, if we can pay 70 cents or 60 cents or 50 cents for that dollar, the further away we can get, the more room there is to come back to intrinsic value and generate a really high return that way. So that's the first couple of things I wanted to touch on. I want to focus on a couple of common misconceptions about value investing versus other types of investing. Often you see these articles that value investing has underperformed for the past decade or the past 20 years, and value investing is dead and all this kind of stuff. So let's get into that next, and I want to bring up a couple of points that again are often missed by the wider sort of investing community. So let's get into that. So I'm going to put some screenshots up. These articles are everywhere. I'm sure you guys have come across them, that value investing is dead, or value investing has underperformed growth investing for the past 5 years and past 10 years or whatever it might be. And I want to dive into that and speak on this topic a little bit. So first off, I think a lot of the analysis that's sort of done on this type of value investing versus the rest type analysis is often a little bit misleading. I think first off, you have to define what you mean by value investing. Oftentimes you'll see something like a value index, or they'll use some sort of price to book ratio filter to pick up a list of companies that fall into the value category. So they'll just be looking at low price to book or low price to earnings, or any of these quite old school principles to just pick up things that are cheap. And when you compare that against a 10-year long bull market of all these growth and internet companies that are doing really well, it's no surprise that that sort of cheap group of stocks has underperformed. I think there's probably some merit to the argument that value investors generally have underperformed the stock market, especially in more recent years. I think it's just the sheer nature of things that value investors tend to be more and more conservative as the market continues to climb, and we've seen that with a range of value investors. We've seen guys like Phil Town basically completely exit the market. We see Warren Buffett sitting with about $120 billion now in cash and short-term investments, which is approximately, this is a bit of a rough guess, but approximately 20 to 25% of all of the assets of Berkshire Hathaway, less the liabilities, something in that ballpark. So even though it seems like a huge amount of money, it's not, half his portfolio or anything like that. But regardless, he's holding a lot of cash, and lots of investors are holding a lot of cash. Ben Graham speaks about this in his writings as well, that the higher a bull market goes, the longer it goes on, the more there's this exuberance out in the marketplace, the more that value investors should be moving to bonds and shorter term investments and kind of exiting the market slowly. And they actually expect to sort of lag behind. They're quite open about this. You'll see this in several of the early Buffett partnership letters that, during bull markets, we completely expect to underperform. It's in bear markets and sideways markets where value investors really can shine. It gives them more opportunities to find these big discounts to intrinsic value and then really perform very well, the years following after finding those opportunities. So that's the first thing. I think the definition for a lot of people of what value investing is wrong. It's probably the second major flaw in these types of value investing versus the rest analysis or analyses. I think, like I say, a lot of people define value investing as low price to book or low price to earnings or something like that. In my mind, and I think in the mind of most of the modern day value investors, is that value investing is simply buying something for less than it's worth. And it's no more complicated than that. It doesn't necessarily have to have a low price to book ratio. Buffett bought into Coca-Cola at huge multiples of book value because they have all of these intangible assets that aren't necessarily recorded in a tangible equity figure. They have the Coca-Cola brands and they have all of these things, secret recipes for Coca-Cola and that kind of stuff that are going to produce a lot more cash and very, very high returns, even though it's not a physical asset, it's not a plant or anything like that that you've got in some factory somewhere in the States. So I think price to book doesn't make a whole lot of sense for several businesses now, especially when you have these intangibles. If you look at a business like Facebook, they have a very small amount of tangible assets. They obviously have the Facebook platform and the Instagram platform, and they leverage those assets to make a large return. So looking at a simple price to book metric isn't a good way to value a business like Facebook. And we've seen value investors get into Facebook. We've seen Bill Miller, for example, has a quite large position in Facebook, or at least he used to. And Warren Buffett is obviously a major investor in Apple, where again, they're one of the lower PE stocks in that kind of world of FANG and internet and technology companies and all these things. But they are still a much higher price to book than you would typically see a value, old school value, Ben Graham style investor getting into. So I think the analysis, long story short, is a little bit flawed when you could just say, these are the value stocks and these are the rest, and the rest has outperformed value. I think that's a little bit naive. The value and growth are like this. They're completely intertwined. If you have a company that makes a high return on capital and a company that makes a high return on capital and grows, the company that makes a high return on capital and grows has a higher value. It doesn't necessarily, this thing has a higher value. Value investors will pay more for a company that grows, and so you can't just categorize value into only buying cheap things that don't grow. There's a range of things here. Sure, some people are still in that old school kind of camp where they just look for low price to book. Others, like myself, are looking for businesses that will grow over time. It's much easier to, as Charlie would put it, find a great business and sit on your ass for 20 years than find undervalued, non-growing businesses that appreciate to intrinsic value, then having to shift that money back into a new business and do this thing all over again. Charlie Munger, for example, invested in Costco several years ago, continues to hold the stock. He's had to do absolutely nothing except sit there and watch it go up and see that business grow over time. So little bit of a ranty video. I apologize for that. If you did enjoy it, definitely hit like and subscribe. I hope you did get something out of it. These are thoughts that flow through my mind as I'm reading away or just sitting down pondering life. So I hope you enjoyed it. As I say, if you did, hit like, hit subscribe, and I will see you in the next one. Cheers.